All right, everybody. Stocks by the numbers. Welcome back. I wanted to do a quick look here into Dollar General Corporation, ticker symbol DG, listed here on the New York Stock Exchange. Stock closed at 84.99, down a little over a point, about 1.2% here on the day. It's currently sitting 85 even after hours. Now, this stock, obviously, this is a dollar store company, in case you're not familiar, and they kind of have a little bit of everything. And what Dollar General, kind of what their strategy is that throughout the states here, you have your larger cities, your larger towns, and that'll usually be where maybe you'll have a larger retailer, something like a Walmart located. And then kind of off to the side, kind of like on the outskirts of town to kind of take care of the smaller residential areas, down those little side roads and whatnot. That's where you're going to find like these Dollar General locations. And I'm also in an interesting location here. I'm upstate New York, and similar situation. I'm kind of like half a mile out of kind of like Main Street, if you will. But like here down the block, there's a Dollar General. You know what I mean? So like in between these big stores, that's where Dollar General's setting up their locations. And in my opinion, that seems like a pretty good strategy. And even though some of the numbers have been coming in light recently, the growth cannot be denied. And if we look here at last quarter, you can see that they missed on the EPS side here, reporting $1.70 a share. Estimates were $1.79 a share, missed that by roughly 5%. And the revenue here, estimates jumped up to 10.37 billion, and the company did technically break that 10 billion milestone here. 10.21 billion they brought in just for last quarter, but technically missed that estimate by about 1.5%. So while some of these, gross margin, operating margins came down a little bit, I know they said comp store sales were down. Technically, I think they were up, but they were, lower than expectations, right? So this is what we talk about when analysts and investors alike see that there are multiple misses across the board. That's when a stock will really take a big hit. And even Dollar Tree dropped recently as well. So DG was sitting here at about 120, and it instantly dropped and opened down at sub 100, and even ended up dropping down to, yeah, slight 78 right there. 77.96 was the new 52-week low, and then we had a bounce back up to the high 80s, and now we're sitting here in the mid 80s. So, couple of things here. First of all, again, technically looking at the numbers, again, the quarter before was a nice beat on the top and bottom line. Before that was also a nice beat at the top and bottom line. And before that as well. But going back from these highs here to 260 roughly, we can see that we had back-to-back misses, right? We had back-to-back misses. That's what really helped accelerate the sell-off. And even here, we got above that 10 billion mark again, but technically we missed, right? So the stock came down, it ran up, kind of flattened out, and then started to begin the sell-off going into next quarter's earnings. And before that, then we miss on the EPS, right? So what became a consistent, what was a consistently growing, beating estimates business, now became a situation where we might, we win one, we lose one, we win one. So now we're kind of getting a little more inconsistent. But I will say, I think the company is severely undervalued right now. Just my opinion. But I mean, the company just brought in 10 billion in revenue for the quarter. We have a market cap of 18.7 billion. They've been consistently increasing their dividend over the years. It's currently yielding about 2.75% right now. We're trading 13 and a third times earnings now after this big drop. So the PE now looks very attractive. And the beta, of course, the beta, again, is the volatility of the stock in relation to the overall volatility of the market. And you can see that this stock is about a third as volatile as the market. And again, I know we're beating it up here recently, bringing it down to lows, but before that, again, the EPS, like we said, was more beats than misses. This is our first miss over the last 4 quarters. And if we look here, we can see that, again, this time last year, 9.8 billion. Now we're at the 10 billion mark. And yes, these companies, these dollar stores kind of, they keep their prices as low as possible, right? Because they rely on the volume of customers. So the profit margins are very, very tight. And as you see, the company is just kind of slightly positive here with a net margin of about 3.6%. But again, the revenue is growing nicely, even though their profits have been taking hits over the last couple of years. And we can see going into 2020 when we had those lockdowns, sub 34 billion. Then we come out above 34 billion, then almost 38 billion. And now for 2023, 38.69 billion. And we hear word that, they're still opening more locations. And like I said, they're finding these small little kind of side roads off of these little like communities and whatnot. They'll build them kind of like down the block from maybe like a bunch of condos, right, where there's like a whole HOA situation, and you have like 80, 90, 100 units kind of in this complex. And you'll notice that even though it's like a quiet area technically outside of the city or the bigger town, you'll still have, your stores and whatnot, but there usually is a Dollar General over there. So that's why, again, I have to say, I think that they are picking their spots pretty wisely. And the real issue is what seems to be, even though, again, some of these numbers have missed estimates, so I understand the stock pulling back, but it also seems kind of unfair because they seemingly compare it to Walmart, it seems like. And they always say, oh, Walmart, came in above estimates and, Dollar General didn't. So, we're going to chunk them down big. Or Walmart, the e-commerce side of Walmart now that they moved to digital is growing nicely and customers seem to appreciate it. So, that's going to hurt Dollar General. So, they make kind of these contrasts and these comparisons, and they kind of hinder DG's value right now. And first of all, if we just look at revenue, again, the company, what did we say? 38.7 billion. So just looking at the revenue to market cap comparison, the market cap right now is about 50% of last year's revenue. And we're only trading 13 times earnings, which is why I feel this big drop down here into the 80s, a little bit of an overreaction. And chances are it's probably, in my opinion, it's probably going to run up here and fill this gap. Possibly going into next earnings even, which is slated for the first week of December. But if we pull up the actual fundamentals for this company, it doesn't add up too much to me. First of all, look at this dividend growth history here, just going back to 2019, $1.28 a share, up to $1.44, grew it coming out of the lockdowns to $1.68, up to $2.20, up to $2.36. So the dividend yield has essentially doubled here over the course of about these 5 years. So the company, as the revenue consistently keeps coming in, they're consistently paying out more and more to shareholders. Technically, in my opinion, is a good sign. Assets currently outweighing liabilities in both the short and the long term. I do see the debt really started to climb up coming out of 2020. But again, they continue to expand the business, open new locations, and also, even though I don't want to say they're getting attacked for not having e-commerce, but it's like always mentioned. That's what I mean, and it's constantly compared with something like a Walmart, and they recently teamed up with DoorDash, I believe, right? So now, yeah, you might not be able to order things online, but you can probably make like a little checkout list and pay a couple of bucks and have someone drop it off, via DoorDash. But as you see, debt right here about 18 billion, 1809, 1812, 1821. So the debt's slowly going up. However, we can see something like the free cash flow here for last quarter, 635 million. That time last year, 130.8 million. So the free cash flow is up about $500 million, and cash on hand right now about 1.2 billion. This time last year, 350 million. Right? So the cash flow, the cash on hand that they actually have, that seems to be growing nicely. Again, assets outweighing liabilities, both short and the long term. Total assets minus total liabilities yields total equity. And we can see that as the assets have been bouncing around, getting higher and lower than this high 31 billion mark, we're kind of back to where we started. But going back the same period, you can see liabilities are down, 7-8%. From 26.4 billion down to about 24.5 billion. So that yields higher equity, as you see. And now we're up to about 7.25 billion equity. Book value, $33. Several quarters back, we were at 25. Now we're up to 33. So that's roughly about 30% growth in book value just over these, 7 quarters. But if we look at our quote-unquote fair value, the way I personally like to do it, total equity is positive, 7.25 billion. Debt is about 18.25 billion. So if you subtract debt from equity, now you have about minus 11 billion. The company has about $1 billion cash on hand. So now you're at minus about 10 billion. But if we look at the revenue that the company brought in, it's 38.69 billion. And also they were net income positive. They had profits. So if we add those numbers up, now you're over 40 billion. So we were at negative 10 billion. Now we add this 40 billion. So now, in my opinion, the fair value of this business is roughly 30 billion. And right now the market cap is 18.69 billion, which is why I tweeted out earlier and mentioned in the Discord and then wanted to make this video just to lay it out for all of you that in my opinion, this is a pretty big overreaction. And while they can continue to beat it up in the short term and bring it back down to the mid or even low 70s if they want to, in my opinion, excuse me, over the longer term, it really shouldn't be an issue. And I feel conservatively, I think I tweeted out maybe like $145, $150 a share, which again would bring us to like a $30 billion market cap. That's where I got that price from. And then if you want to even go, if fair value is roughly 30 billion, if you want to go even 1.5 times fair value, not 2 or 5 times fair value, just 1.5 times fair value, that would be a market cap of about 45 billion. Which is, again, roughly, about 150% higher than where the stock is currently trading, which would bring us to over $200 a share. So that's why, again, if you want to follow me on Twitter, it's at StocksBuyNumbers, because, of course, the whole thing didn't fit. But basically, I tweeted out, I just said, been looking at DG, stock went back to 2017 levels, but people failed to see that the company posted over 10 billion in revenue last quarter, continues to open more locations. My personal long-term price target is about 150 conservatively, $210 non-conservatively. So again, when you look at at something like that and you hear a number like that, you say to yourself, no, that's extreme. Like there's no way this stock could, double and triple. But if you look again, that's kind of where the stock was, and even higher, right? I mean, I said non-conservatively, we could see 200, 210. Stock was up at 260. So to say it could go back to, 160, 180, 200, I mean, you're really not fishing for the moon in the lake, right? This is doable. And also, at how much it chunked down and rallied up over the quarters, over the years on the way to those heights, it'd be understandable if someone turned around and said, in their opinion, DG is undervalued, and if they post, 1 or 2 really good quarters, the stock might, break back up, and you could see it, excuse me, you could see, $150, $160 a share again, no problem, right? So that massive move, even though it's a big percentage move, that rebound could take place over the next, 12, maybe 18 months. And again, I know I always lay out that timeline, and a lot of you who are traders, it seems like it's such a long time, but I'm telling you, it really isn't a lot of time. But of course, this may kind of fall more into my wealthier, kind of longer term holder investing demographic. But again, in my opinion, if I had, a couple of $100,000 or a couple of mil that I personally wanted to park somewhere, I mean, we, of course, may find something that's more attractive. But here in this current situation, again, look at that nice run up. And then to just immediately chunk it down so quick. Again, this is why I feel like, even looking at the fair value of the business, I feel, in my opinion, this could be a very nice, longer term, slow, steady rebound play. And of course, they're paying you a dividend to own it the entire time, right? So again, this is why sometimes we say investing is different than trading, but if you did have a nice chunk of change and you wanted to park it somewhere, again, you could be looking at potentially, 70, 80, 100% growth here conservatively, paid a dividend to own it, And of course, ideally, you'd want it to take longer than 12 months so that you'd pay half the amount in capital gains tax. So shout out to, the wealthier people who definitely have a big chunk of cash on hand, because this may be something, in my opinion, that you might want to throw on your watch list. But we just broke down the numbers again, and that's why I think that even doubling up from here, 160, 170, really shouldn't be an issue. Now, I understand the argument here. If we check some of these fundamentals, I understand that some of these margins, again, technically are down, but if we look at something like the PE, again, sitting down here, 13 and a third, before that, the lowest we saw was 13.7, but before and after that, we were in the high teens, even above 20 at times. So that's why I know technically they missed on EPS and revenue, but I don't know if I would classify it as a pattern, so to speak, and I don't know if I would just start shorting the crap out of the stock just because of what happened. But that's just me. That's the way I'm looking at it. Price to sales now trading less than half, which, as you see, is the lowest it's been going back the last several quarters. Price to cash flow down to 5.7. I mean, before that was 8 and then double digits. So this is why we're really bringing this thing maybe too low, in my opinion. And we were up here trading 4, 6, 8, 9 times book value. We were holding 4 and the high 3 times book value for about 4 quarters. And now you can see we're trading 2.6 times book value. So in my opinion, for a business that has grown as much and as well as Dollar General has over all of those years, to completely bring it down this much, in my eyes, I have to say, it seems like an overreaction. And I know after making this video, if everything sells off and this stock hits new lows of like 71 or like 65, and then U-turns and rallies back up to 100 plus, we both know there's going to be those people, see, it went lower, you were wrong initially. But at the end of the day, like we say, if we have high confidence and high conviction, especially in an investment, and you have the capital to buy shares, not options, so that you're not, under the gun with that expiration date. If you can just hold and wait, then yes, chances are, in my opinion, this company has a very good chance to get back on track and have the stock rally back up to well over triple digits, and you can see some healthy percentage returns while collecting a dividend, while potentially paying half the amount in capital gains tax on the long-term gains. But also look at this as well, right? We just crunched the numbers. I said, in my opinion, I personally put fair value of the business at about $30 billion. Look at the enterprise value. What another company would be willing to pay for this business. $35.9 billion. Now, granted, it was up here in the 60s, and it has, dropped down with the stock, because it basically just follows the stock. But, I mean, we're talking almost a double from the current market cap. And that's why I'm saying we may still have short-term volatility, and Wall Street may potentially try to chunk it down another little bit, take it that next leg lower, drop it into the 70s, maybe try to scare out some longer-term investors. But again, in my opinion, as an investment, this company really should come back, and I think this is an overreaction, and I think I really do believe the market cap, before you know it, it'll be back up to 24, 28, 32 billion. And people will start saying, oh, Dollar General, I knew it. People love dollar stores. Money's tight. People are trying to save money. I knew I should have stepped in and bought that in the 70s and the 80s. And now it's worth, 135, 142, right? Because we know how it works. A lot of the times anyway. Again, the only real issue from this point, as I said multiple times with a lot of other stocks, is the fact that markets kind of continue to stay up and sit at these highs. So if we decide that, the music stops and the game's over and the markets start chunking down 10, 15, 20% from these levels, then obviously, even looking at metrics like this, as we know, practically every stock across the board will take a haircut. But we can see that over these last quarters, our return percentages are down. Gross margin was up here in the high 29s, 30%, drops down into like that 26, 27% range. And even though technically it's down, about 0.2% quarter over quarter, you can see it's still maintaining, right? It's still maintaining. And this is why I like to look at these fundamentals as well, because in my opinion, what this looks like to me is, again, stable, steady, right? If you're telling me, yeah, it used to be 30, but now it's like 28, or this quarter was 27.2, next quarter 27.8, next quarter 27.6. Like, yeah, it's not, consistently climbing and rebounding back up quarter over quarter, but it's holding that 26, 27, 28 level, right? So it's steady. The operating margin, again, same thing. Yeah, we were up here at 9, 7%, dropped down to sub 5, high 5, 5.5. Now we're at 5.39. So technically it dropped a little bit quarter over quarter for the last 2 quarters in a row. But, it really isn't the lowest it's been. And again, it's still kind of holding this 5, kind of mid 5 range here. So that's why, in my opinion, I really don't view it as a massive red flag. Again, is it technically a negative? Could the stock go down? Yes, I understand. I understand. But again, longer term, that really doesn't seem like too big of an issue. And I'm sure a lot of business owners can attest to that. But of course, every business is different. But something like the EBITDA was up here, slightly above double digits, 9%, 6.6, back up to 8. Holding the high 7s, and again, technically down quarter over quarter, but still holding the high 7s, right? If this dropped to 5.8%, right? Then we can say, okay, something's going on. It may take, 1 or 2 quarters for them to restructure, get their ducks in a row, and we can come back maybe in 5-6 months and check in on the stock price, and maybe we'd be able to get it even cheaper. And of course, that can still happen, but in my opinion, based on the numbers I'm looking at here, even here in the 80s, if we drop to the 70s, I still think it's a good buy here, in my opinion. Net margin percentage, 6.5, 5.5, drops down to sub 3, gets back above 4, 3.66, 3.66. And this is what I mean when we talk about stability. It's holding steady. It's holding steady. Inventory turnover. See, this is what I mean. 4.2, high 3s, down to 3.7, 3.8, above 4, 3.98, 3.97. I mean, stable, right? Steady. Asset turnover, again, how much revenue the company's generating off of said assets on its balance sheet. This seems to be bouncing around, but it did dip all the way down to 1.18, as you see here. Now we're almost back up to 1.3, where we were, about 4 or 5 quarters ago. So, again, like we say, can't keep a good man down. And this is why I always personally liked Dollar General overall. Not even just as a stock, overall. Because it's one of those places, as we said, that they're kind of off to the side. They have a lot of these locations near residential areas. People are hurting right now. Hyperinflation, interest rates are up, right? Mortgage rates are up. Anyone who bought a home over the last, 2-3 years, you're paying out more than other people used to. And that's what I mean. When it's just little hits to your bank account across the board, a little more for this, a little more for that. Oh, gas is up. Now that costs more, right? And then you add all that up across the board. Then at the end of the day, you realize you have 30, 50, 80% less discretionary funds, right? So whether you want something or you need something, to be able to go to one of these, dollar store locations and just get something for a couple of bucks, or have it, priced much cheaper than in a, a larger retail store, it's a big plus. It's a big plus. And that's why people are still hunting for the deals. And again, even though Dollar General slightly missed that revenue, I think getting back above that 10 billion milestone mark and coming close to it, I say it was a valiant effort, in my opinion. But debt to assets, we can see slightly up here, 5.5 to 5.7, but the equity, as we saw, seems to be consistently increasing, right? So our debt to equity was up here well above 3 and dipped into the high 2s. Now it's down to about 2.5. And same thing here, the long-term debt to equity as well was up to almost 3. Now it's down to 2.2. So this is why, in my opinion, it seems healthy. It seems healthy in the numbers. I like this growth here over the last couple of years of this dividend. And you can see now the payout ratio, was here in the high teens, broke up above 20% back in 22, as of 2023, payout ratio is over 30% now, right? So they're trying to reward the shareholders here. And you can see over just the last couple of years, we went from 32 to 36 to 42 up to 55, 59, where we're currently sitting right now. And ex-dividend date coming up. Again, ex-dividend date different than the payment date. Ex-dividend date is the date you need to be on record of owning these shares in order to receive the dividend on the dividend payment date. So that's why a lot of times, again, with these dividend stocks, you'll see maybe some volume come in above average, the day before, the day of. A lot of people jump in so that they can collect the dividend. And then as the company pays the dividend, that's when you might see the stock start to come back down a little bit, because technically the company's paying out millions or billions to shareholders, right? So here they're worth more because people are piling in. People want the dividend. And now here they're worth less because they're paying out the dividend, right? But we know that a very good sign to see is a company that stays with its dividend, doesn't cut it, doesn't halt it, or in DG's case, has been consistently increasing it over the years. So investors always like to see that. I mean, you're getting paid to hold shares, right? So it's a very good incentive for investors. But here on the EPS side, we can see we have been kind of hit and miss, right? Over the last 7 quarters, we have 4 beats, we have 4 misses. 4 beats, 3 misses. And also, it looks like profitability is going to take another hit next quarter. Again, I believe that's the first week of December, we said, for next earnings. But we can see EPS expected to be below $1 a share, and then it's going to start storming back the tail end of this year going into 2025. So only time will tell, of course. But for all we know, this big correction in their earnings and now having the rebound over the next 2, 3, 4 quarters. This is why I'm saying, in my opinion, it may be a good idea to keep an eye on this one, throw it on the watch list, and consider, taking a position here that it's beaten up. And if they're able to get back on track, you're just going to take advantage of that growth, that rebound. And again, if we look at the revenue, 10.2 in Q4 of 22, which seemed like their biggest quarter. And now you can see here we're halfway through 2024 here in Q2, and the company brought in 10.2. And, they slightly missed here in Q2 the year before. I'm actually surprised that estimates were so high here at 10.37. Because this looks like it should be the estimate for here. And this estimate is now only slightly higher than what they just reported. So that's actually kind of interesting. But yeah, I mean, maybe analysts felt that, during those couple of months and we were just coming out of like the summer months and the nicer months. So maybe they felt that, there would be more foot traffic and more volume going to DG, and they came up a little short here, 1.5%. But I will say, even if you look at these misses too, they do seem to be slight misses. I know the EPS here, we had a big chunk miss, and even this last quarter they missed by 5%, several cents. But here on the revenue side, you can see 1/3%, 1.33%, 1.33%, and here 1.5%. But again, it was a pretty high estimate, and I think the company made a valiant effort. So now if we're kind of holding this high 9, potentially 10 plus billion now moving forward in a normal, quarter, then I would kind of give the company personally the benefit of the doubt to come in above these expectations for Q3 and Q4 currently on these 2 revenue numbers. So we'll see what happens. But over the years, more beats than misses going back to 2017. We have 4 beats on annual expectations of revenue, 3 misses. We can see for 24 estimates now above 40 billion for annual revenue, and expected to climb by about 2 or 3 billion year over year now moving forward. 2025, 42 billion, 26, almost 45 billion, 2027, 47.33 billion. So we're still expecting continued stable, steady growth for DG over at least the next, 3 years or so moving forward. On the annual side too, I know we're recently beating up the profitability. And first of all, it's basically been consistently growing year over year, minus this big drop and pullback here for 2023, even though they did still come in above that annual expectation. But also going into lockdowns, the company had a nice profitable year, and then really a slight miss here. Again, 0.7%, missed by 8 cents, posting 1062 on estimates of 1070. And then they slightly came in above expectations for the next 3 years in a row. So again, this is why, oh, comp sales are a little lower than we expected, or oh, you missed on EPS, your stock's down, 28%, 32%, you're hitting new lows. In my opinion, I do think it's a little bit of an overreaction, because technically in the numbers as we looked, the stock really wasn't drastically overvalued, right? So we put fair value, in my opinion, at 30 billion, which would bring us to whatever, $160 a share, we'll call it. The stock was at 260. So, what's that? That's 5/8. That's a little more than 50% higher. So, yeah, market cap was what, like 50 billion and change, as opposed to that 45 billion number I threw out. So we were a little more towards 2 times fair value, as opposed to that 1.5 times fair value that I'm predicting long term, right? So that's not an extreme multiple. It's not like looking at something like Nvidia or Palantir, with the way we've really exploded those companies' market caps, where we can look and we can say, like, oh, you missed, now we really got to bring you back down, just because you ran up so much. And I understand DG stock was up for a while over the years, but it deserved to be, right? So that's why right now, in my opinion, I just feel like it's kind of like a short-term reset here over about the last year and a half. And also, people like to tie DG to the, interest rates and the rate of inflation and everything else. And I can understand that, but also it's an election year, right? And in about a month and a half, we're going to have our elections here in the States. And I know a lot of people are kind of leaning towards the Trump side. And people are talking about, how markets are going to react and what to look for if Trump gets back in the White House. And in my opinion, he's probably going to make it a priority to lower practically all of these rates across the board. So also, even though it might be rough here, DG, for the next 3 to 6 months, also keep in mind that if Trump gets back in and inflation starts to come back down and all of these rates, again, start to come back down to where they were back in maybe like 2019, right, before the lockdowns happened, then technically, in theory, these cheaper retail stocks should start to climb and rebound back to where they were. So that's another thing to keep in mind as well. This could technically be like an election year, kind of like Trump play, if you will. If you're looking for something like that, it could work out. I just want to make sure I didn't miss anything, right? We looked at everything. Consumables, as we see, is basically their bread and butter, but for the most part here, I mean, the apparel has kind of stagnated, but even something like the home products here, going back to 2017, 1.4 billion, right? And we get up to about 2.3. Now we're sitting here slightly below 2.2, but even looking 1.4 to 2.1, I mean, that's 50% growth over 7 years, which technically on average would be about 7% a year growth, So that's what I mean. We make it seem like, oh, you missed earnings, your stock is worth 30% less. And again, in the moment, it sucks. But in my opinion, it could be an opportunity. Seasonal, sub 3 billion, we get up to 3, 4, 418, 418, 408. So we've been kind of holding that value since 2020. And it technically is, 35, 40% higher than where we were in 2017. And of course, consumables, 18 billion, climbing up into the 20s, and now above 30. So this is some serious growth over the last 6-7 years. Definitely nothing to put your nose up at. But let's check some recent headlines here, and we'll try to wrap this up. Costco, Dollar General initiated at hold. Price target 85 a share. Okay, well, the stock's at 84.99. So thanks. I love when they do that. Has an average rating of outperform. Price targets ranging from 75 to 130. Whoever has 130 has my respect. Redburn Atlantic adjusts price target on DG to 90 from 150, maintains neutral rating. See how I always say, though, this is why you don't, in my opinion, I wouldn't completely follow these analysts, right? Because 150, in my opinion, is probably where the stock should be, right? So to slash your price target by 60 points down to 90 because they had a bad quarter, oh, now we have a neutral rating. Like, you know what I mean? It just seems like a drastic overreaction. Like you were so bullish, everything was fine, you saw the growth, now all of a sudden down to 90, the stock's in the 80s. So that basically means that you think it's going to remain flat over the next several months. I just don't buy it. I think it's too drastic. Okay, we're moving. Yeah, this guy's selling shares. Who's buying shares? U.S. retailers rise as interest rate cut signals increased spending. See what I mean? So we try to have everything interconnected. But if we heard, supposedly, that rates are going to come down and, Trump's going to get in there and it looks like he's the leader and, everything's going to change. Okay, so then something like DG should be ready to go. Dollar stores expand aggressively even as sales shrink. Dollar stores contending with slowing sales, weaker earnings. Dollar General and Dollar Tree, nation's largest dollar store chains, are together on track to open more than 1,300 new locations this fiscal year. That's what I'm saying. This is down from last year. Okay. But it still far outpaces other retailers' expansions, yeah, reflecting dollar store executives' belief that new stores are the key to juicing sales and capturing market share. Yeah, of course. Of course. Because as I mentioned, if you're, off the side road and you're not on, right off of Main Street, that's where they like to open their locations. So if you're in an environment like that, then yeah, I'm sure a lot of people are talking to each other and saying, oh, what we need around here? We need like one of these dollar stores, one of these Dollar Generals like right here so I can go grab, a couple of things I might need. I don't want to go all the way into town, to go to the big grocery store or the market or something, right? This is why they've consistently seen steady growth in the business. The openings come as dollar stores grapple with slowing spending from their core low income, growing competition. Dollar stores, which are largely in person, are also a strategic disadvantage when it comes to e-commerce. See what I mean? Rivals such as Walmart and Target have invested heavily in recent years to integrate physical stores with online shopping. Yep, always had this niche. Combination of value and convenience. Now he added, particularly for middle and upper income shoppers, the shift toward this digital shopping has become the new convenience play. Right, for middle and upper income shoppers. Now, that's who Dollar Tree supposedly said is kind of their demographic. And we also, several months back, I did like an earnings update video. A lot of people were interested in Five Below, whether they were going to beat or miss their numbers. And they ended up missing. And they kind of said the same thing, right? Oh, our demographic of like the middle, kind of upper middle class, they spent less and they might be vying for dollar stores for even cheaper than $5, right? Because that's the whole thing. Five Below, everything's, $5. So instead of the $5 store, I guess people are going to the dollar store, right? So that's why this technically applies more to Dollar Tree than it does Dollar General. Dollar stores historically thrive during periods of economic uncertainty. Yes, we know this, such as the recent period of high inflation. Yep. Dollar Tree posted record high sales during the 08-09 financial crisis. In 2020, a rise in unemployment at the start of the pandemic boosted Dollar General as customers sought out cheaper groceries and household essentials. Yep. 4 years later, retail executives and analysts describing a bifurcation of the consumer landscape. More affluent shoppers are largely doing fine as inflation slows, but lower income Americans remain pressured by higher prices and are spending less. Households with an annual income of $30,000 or below make up 60% of Dollar General's overall business. So slower spending among these customers has a significant impact. Right. But we also, supposedly from this analyst at Piper Sandler, I guess, particularly particularly for middle and upper income shoppers. The shift towards digital shopping has become the new play. But Dollar General deals with 60% of their customers make $30,000 or below. So those are the people that they're catering to. So supposedly the people who are, just getting everything delivered, and yeah, I'm not going to the store, and I love e-commerce and Amazon, and just drop me off stuff. You pay extra for that convenience. So that's why middle and upper class people are vying for that option. But everyone else, which unfortunately is a really big chunk of our company, is really struggling. We go on social media and you see, like 20-year-old idiots, talking about, buying sports cars for a couple of $100,000, or I just spent millions on this house, or, I love the videos where they buy, like 50 iPads and they just like pass them out to people. Like, you have to remember that is not the norm. That is not the average. And people out here, I'm telling you, people, they watch every red cent that the sign at the gas station changes, and they wait for the opportunity to put gas in their car at a little bit of a discount. Even go into a place like Dollar General, they'll consistently go into a place like that, and they'll keep an eye on the prices, and as soon as it drops down a little bit, and the store's trying to help out consumers, that's when they strike, and that's when they throw it in their cart, because they're really tightening the belt and trying to stretch their dollars as far as they can. So that's why, again, something like DG, in my opinion, I think really should be more than fine. Even if hypothetically, Trump gets in and everyone thinks everything's going to be great. Let's just say hypothetically it stays the way it is, right? But he wins. So let's just say everything stays the way it is. Well, what's performing well? Dollar General, believe it or not. In my opinion, I think DG is going to hold up just fine. And remember, if everything does get better, then these people who are really living a rough, tight financial life are going to be able to spend a little bit more or get a little bit more for their dollars, right? So that should actually technically fuel sales even more. So again, whether it's good, bad, or ugly, I think DG should be fine. Rival Dollar Tree is blaming a pullback by households making more than $125,000 in annual income for worse than expected results in the second quarter. So Dollar Tree is saying, again, people more than 125K, worse than expected results. Dollar General's catering to the people making 30K or below. So this is not many people, believe it or not. Competition and price cuts from rival retailers are hurting sales. Dollar stores have an uneven track record for store operations, plagued by cluttered aisles, understaffing, and retail theft. Well, only in certain places. Quote, they've relied on this new store growth without making sure that the operations and the existing stores are really solid. Well, you also have to remember there were people who crunched these numbers and play out these scenarios before they actually, lease the buildings, excuse me, before they actually lease the buildings and put their name on it and stock it with inventory. Right? There were people who run the data. Oh, there's this many people in the area. We assume this percentage of people will come to the store. If the average person spends this much money, then we'll be looking at this much for the year. What do you think? People are just driving down the street, say, "Oh, that building there, let's open it there." No, you do your due diligence. So, I appreciate what the analyst is saying, but again, because of the type of business, you're probably going to do well pretty much anywhere you put it, unless you open one probably right next to a Walmart, right? Dollar General, with more than 20,000 locations in 48 states, boosted hiring last year in an effort to improve customer experience. Very nice. Adding more employees to the self-checkout section in its stores helped reduce retail theft last quarter. There you go. Although it remains above 2019 levels. Yeah, where though? Right? We can have that argument as well if we want to get into the political side of it. Where? Show me the map of where the extensive retail theft is coming from. Because if you're going to point just on 2-3 locations on my map, then guess what? It's not a widespread epidemic of retail theft that's plaguing Dollar General, right? I'm sure you guys can appreciate what I'm saying there. I don't want to get into it too much, but Dollar Tree, meanwhile, is expanding its assortment at a wider price range and considering selling its underperforming Family Dollar chain, which it acquired for roughly $9 billion in 2015 but never succeeded in turning around. Parent company closed nearly 700 stores this year, mostly Family Dollars, but still expanding. Dollar Tree opened 300 new locations, 170 leases. Reopened more than 100 of those locations. Okay, very nice. Plans to add at least 50 more by the end of 24. Dollar Store's lack of robust online platform poses a more structural concern. Dollar General, in particular, has historically won customers by opening stores in rural areas where Amazon and other online retailers have had less reach. That's why they're doing well, as I said. Oh, I need socks. Oh, I gotta go all the way to Walmart. I'll go to Dollar General, right? I need a snack. I'll just run to Dollar General. They have everything in Dollar General. They really do. They have a little bit of everything. So you can probably find what you're looking for. Okay, retiree cleaning supplies, other items she orders on Amazon are often delivered within 24 hours to her home in the St. Louis suburbs. But it takes longer to get deliveries to her lake house in the more remote town of Kissy Mills. Often finds herself running to the nearby Dollar General. It is less than a 10-minute drive away, much closer than the nearest grocery store or Walmart. God, I hate being from New York. But there you go. Right? Walmart's, I gotta jump on the road. I gotta drive for 25 minutes to go to the Walmart. Oh, they open a Dollar General, a mile and a half down the road. Okay, great. I'll go there if I ever need anything. That's it. That's their bread and butter. And it doesn't matter if people, own a $900,000 home and make $200,000 a year, or if people live in an apartment and pay too much rent and barely have excess funds at the end of the week. It doesn't matter. If either of those people need something, they're going to go to the closest location. And again, it seems like Dollar Generals are really just popping up all over the place. And it seems to be working. You can almost find what you need there without having to make a trip all the way into town. You can almost always find what you need there, excuse me. But now Amazon is beefing up its delivery to far-flung parts of the U.S., threatening Dollar Store's corner on convenience. And investments by big box retailers integrate their in-person and online shopping services, excuse me, are paying off. Definitely getting sick. Walmart outperforming earnings as its e-commerce sales grow. See what I mean? They're constantly making that contrast. American consumers been more inclined to shop online since the pandemic. Sit on my couch and shop. It is unlikely dollar stores already operate on thin margins, will spend significant money building their own e-commerce, but the companies have made some moves. Dollar Tree offers in-store pickup of items bought online. Family Dollar, you can use SNAP, formerly known as food stamps. Dollar General, meanwhile, has partnered with the delivery company DoorDash. So see, that's why I think, in my opinion, Dollar General kind of saw the writing on the wall. And they see that e-commerce is a popular business, and sometimes for any reason. If you're not feeling well, if you're elderly, right, if you have poor mobility, maybe it's really a process for you to get up and go out and go to the store. So Dollar General, while they're not individually delivering on their own, they decided to just team up with a delivery company. And again, anyone who falls into that kind of demographic can still order their products that they want, and then they can get them dropped off via DoorDash. So I actually think that, like this in-store pickup, that does kind of speed it up a little bit, but also at the same time, I'm kind of ordering it and placing it in my cart online, and then I still got to go to the store to pick it up. So I might as well just go to the store, and you never know what else you might run into, right? And Dollar General, the exact opposite. You basically can place an order online, and someone will bring it to you. Dollar Store execs say they will continue to open new stores. Quote, "We don't believe that by slowing down to any large degree, new stores would be the answer here," Dollar General CEO told investors in late August. So that was a, pretty intense article. But yeah, I just feel like a lot of this is an overreaction. We were there. Evercore price target to 118 from 100. Maintains inline rating. That I respect. That I respect. All right, VP selling shares. Director buying shares. Wolf Research cuts price target from 157 to 92. That's what I mean. Drastic. Drastic. R5 lowers price target from 139 to 92. See what I mean? They all just follow suit. They all just follow each other. If it was me and I had a price target originally above 100, I wouldn't change it right now in this moment. I wouldn't just hop the fence and say, oh yeah, it's crap. Forget about 160. It's going to 90. Like, come on. Adjust price target to 125 from 170. All right, at least it's still up. Dollar stores struggle when Walmart performs well. See what I mean? Analysts sour on Dollar Tree stock. Deutsche Bank price target from 150 to 100. Yeah, shrinkflation. Price target to 87 from 143. Maintained at overweight by Barclays. Target 102 from 154. See what I mean? Price target's just getting slashed 30, 40, 50%. Wild. Wild stuff. But I think that's pretty much it as of late. Maintain equal weight, Wells Fargo. So, yeah, it seems like, again, everyone's just kind of jumping on board saying, oh, they're down. Okay, we're lowering the price target. But again, in my opinion, I think a little bit of an overreaction. RSI was well below 30, climbed back up, pulled back a little bit. Now it's at 30. But in my opinion, again, over time, it really should technically come back up. MACD recently crossed back to the upside, and we may flatten out here for a little bit and try to retest, but I think it bounces. It really shouldn't cross bearish again and lead to more of a sell-off, in my opinion. Probably this retest at least back to the 107.63 50-day moving average, in my opinion, makes sense. Longer term time frame, RSI still below 30. MACD has been steadily slipping over the last several months with the stock. But again, I do think, in my opinion, I do think it bottoms out here very soon. And I think you start to see the curl and the rebound heading into 2025. Because I think people kind of see that 23, 24 was a rough year. And now, again, after elections are over, if we right some of the wrongs, you know, we're going to go up in 25. But that's pretty much it. I'm going to end it there and spoke for way too long probably. But once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. My apologies. I know I coughed a lot during this video. Again, I think I'm starting to get sick, but I saw kind of something of value here with DG, and people were talking about it, so I figured I'd jump on and do a video for you guys. But like I always say, like the video, thumbs up algorithm, right? Helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me, help you. More importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain, so I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time. Have a good day.